Webinar. Very exciting topic today. We will be talking about RWA tokenization from two perspectives, legal perspective and technical on-chain execution, smart contract design. Um, Quite an extensive agenda. Hopefully, we can fit everything into this 1 hour webinar. So I'll start by just general overview of the legal rights, obligations, and restrictions that need to be reflected in the legal documentation that usually comes together with the tokens. And then my co-host Joe will cover the smart contract design, security, testing, so that you can have a clear picture on how those two sides, the technical and the legal side, comes together into one functioning RWA token. Okay, so let's begin. Let me start with this slide that just gives you a clear understanding of this role separation between our organization, Legal Nodes and Sentinel Core, founded by Joe. So basically, we work with founder, asset managers, tokenization platforms to design the legal wrappers and corporate structures that sit behind the token. That would include determining what type of financial instrument the token represents, whether that's equity or maybe a debt note, how those rights are legally documented and enforced. We also help projects navigate regulatory frameworks across multiple jurisdictions, including securities law, licensing requirements, investor distribution rules. In practice, that means structuring the ecosystem of entities involved in the project, defining the legal relationships between them, and preparing the documentation needed to issue and distribute tokenized assets. And importantly, for today's topic, we work closely with Sentinel Core, or development teams to ensure that legal rights and compliance requirements are properly reflected in the smart contract design and token mechanics. So as a result, you have a turnkey tokenization solution. Here I'd like to begin with this topic. Before we talk about what exactly goes into smart contract, it's important to understand that RWA token is not just a piece of code. It represents the bundle of legal rights and obligations that exist in traditional legal documentation. In tokenization, these rights are implemented across three layers. The legal layer defines the rights in contracts and offering documents. The smart contract layer implements certain aspects of those rights technically, and the operational layer ensures the underlying asset and payments are actually managed. When these layers are aligned, the smart contract becomes a mechanism that helps enforce legal rules automatically via blockchain rails. And what kind of rights are usually embedded into that legal wrapper and the token model? The first category would be the economic rights. These determine how investors receive financial value from the asset. Depending on the structure, the token, the legal wrapper, the token holders may receive dividends, interest payments, profit participation, revenue share. It could be structured in various ways. So if a token represents a loan note, token holders will receive periodic interest payments. If the token represents equity, investors may receive dividends or participate in profit distributions. These economic rights must be clearly defined, and we need a clear definition there on how the payments are calculated, when they are distributed, and what source of funds they come from. Without clear definitions, disputes may come up about how returns should be allocated. The next category is ownership rights. In some structures, the token represents ownership of a company that holds assets. It's a very popular way of structuring the securitization or tokenization through a special purpose vehicle, which is a company that actually holds the underlying assets. In some structures, the token may represent direct ownership of a physical asset, such as real estate in some cases, or commodities. Ownership rights determine what happens in situations such as liquidation of the entity, asset sale, or restructuring. Sorry. So, for example, if an SPV that owns property is sold, token holders may have the right to receive a portion of those exit proceeds. These rights must be clearly defined in the legal documentation for obvious reasons. So it needs to be defined whether token holders have the right to that upside scenario of the asset appreciating in value. Another important category of rights would be governance. These rights determine whether token holders have any influence over decisions related to the asset. For example, voting on major asset decisions, approving the sale of an asset, or appointing managers. Governance can be implemented through on-chain voting mechanism, traditional shareholder voting processes like off-chain, or hybrid governance models where some questions might be voted for on-chain and some others would require traditional corporate governance documentation, resolutions, etc. And again, it is something that is important to define in the legal documentation that supports RWA token. Now, we'll move to the category of redemption rights, which determine how investors exit the investment. This can happen through secondary trading or through redemption mechanism. For example, a debt token may have a maturity date at which the principal is repaid. A commodity token may allow redemption of the underlying physical asset, for example, delivery of actual gold from the vault to the token holder. In some cases, issuers may provide buyback programs, buyback mechanism, or redemption windows. So again, redemption mechanism must be clearly defined because most of the investors are actually looking into those RWA tokens for liquidity purposes. And those investors have the right to understand how and when they can recover their capital. Transparency is another critical component. So, token holders must receive sufficient information to evaluate their investment, which typically includes financial reporting, performance updates, valuations, disclosures of important material events regarding the assets or the SPVs that holds the assets. In regulated environments, these disclosures are often mandated by securities law. Again, it depends on the regulatory exposure that the project is willing to be subject to, and the corporate structure and the legal wrapper of the token will define that regulatory exposure. But even in private placements where a full prospectus document is not required, transparency is essential. for investor trust, if a private placement is designed for qualified and institutional investors, those investors will definitely demand certain level of documentation for their due diligence before they actually invest. And there are certain other aspects that are usually embedded into the tokens. Because those RWA tokens are usually securities or regulated investment products. Compliance rules must also be embedded into the token design. So smart contracts can enforce transfer restrictions so that tokens only move between verified investors, eligible investors, if the token is specifically designed only for institutional and qualified investors, for example. This is one of key advantages of tokenization. Compliance rules that traditionally rely on intermediaries or human can be partially automated through the token infrastructure. And finally, tokenization does not remove the responsibilities of the issuer. Issuers still have to manage the underlying asset, distribute payments, provide information to investors. So smart contracts can support these processes by automating distributions or enabling certain governance logic, maintaining ownership records, etc. Important to remember that the smart contract is not the legal agreement itself. It is an implementation tool. The legal documentation remains the foundation that defines investor rights. So far, that gives us an understanding of what RWA tokenization is from legal perspective, the rights, obligations, compliance requirements. We've mentioned several times, those legal rules need to be implemented technically, and that's where smart contracts play a crucial role. Smart contracts are what actually enforces many of the mechanisms that we've discussed. The security, the proper design of those smart contracts play crucial role in the entire process. So here I'd like to pass the word to Joe from Sentinel Core, who will walk us through how these legal and compliance requirements are translated into smart contract architecture and token design.
Yeah, thanks, Iryna. Hi, everybody. Yeah, so this part of the seminar is going to cover the technical side of things. Of course, we want to understand how to implement this side in conjunction with all of the legal requirements and what's mandated, basically. So let's start with an overview of RWA tokenization, and we'll jump straight into the legal rights that you need to implement, including equity rights. So we heard from Iryna about governance earlier and how that plays into equity rights through voting and dividends and ownership. And then we also have to look at how we implement debt rights and how that's realized in the blockchain sense through interest payments and repayments on principal. And then, of course, fund unit rights through redemption and calculating the net asset value. And then real estate tokenization rights through rental income and property ownership. And then we have to look at the compliance side of things as well. So we have transfer restrictions. Again, Iryna's talked about this briefly. So we actually write this into smart contract infrastructure. So it allows you to whitelist and lock up based on token expiry and things like that. And then, of course, there's ways to conduct KYC and AML on the smart contract side of things as well with investor limits. And that works in conjunction with tax reporting requirements and other regulatory triggers such as suspensions and redemptions. And then, of course, we have to focus on probably the most core part, which is the security. And it's inclusive of the design of your smart contract infrastructure. And that includes access control mechanisms, if at all applicable, upgradability, which we'll come on to shortly. And then emergency pause functions. Again, we'll touch on that as well. If you can move on to the next slide, please, Iryna. Awesome. So let's discuss access control and what that is. So just to give you, maybe there's people watching that are aware of this already, but if you're not, the number one vulnerability and attack vector in smart contracts today is still and was and is still access control. And it's simply because a lot of developers don't necessarily pay too much attention to this because they assume that the people with the access control are trustworthy. But what often happens is, irregardless of that, some mistakes can happen just simply by calling certain functions with very limited access control. So role-based access control is ever more important, and you have to have trusted actors. And that is further secured with multi-signatures. So we have multi-signature wallets that we can create that are effectively in control of what certain things are able to do, basically. And so your admin key management will feature into that as well. And again, this lies on top of emergency pause mechanisms. So if, for example, if you've got one or two admin that have been alerted by your dev team that something's going wrong, you want to emergency pause, well, it could be that a multi-sig sits on top of that to add a layer of security or prevent mistakes at least. And so when it comes to code security, we want to make sure that you're implementing the best practices in order to prevent the typical vulnerabilities that exist in today's world. And of course, gas optimization is really important as well, dependent on which blockchain you deploy to. Ethereum, as we know, is probably the most expensive blockchain. So you want to make sure that you're implementing certain methods that are gas friendly. And then we want to look at reentrancy protection. So that lies at number 2 or number 3 vulnerability pattern in the world. It's resulted in millions and millions of dollars worth of leaks. So that's really important to nail down. And then, of course, we want to look at the economic security side of things, which introduces another subsection of attack vectors. And so flash loans are ultimately used a lot today in order to manipulate protocols and blockchain ecosystems, doing so by manipulating token prices and things like that, or even in governance as well. So we have to be very aware of these things. So price manipulation prevention is important, alongside liquidity. Again, these are all 3 attack vectors that can happen through flash loans. And then as far as compliance is concerned, from an integration perspective, we implement on-chain compliance with smart contracts, but that also does not stop from meeting certain requirements as far as off-chain validation is concerned. That needs to be in there as well. And implementing regulatory trigger mechanisms and audit trails and logging. These are all really important. The regulator will expect these things. So let's discuss the common vulnerabilities. We have touched on them, but access control. So in short, if let's say, for example, we've got a claim function to get your distribution or dividends from a real estate tokenization platform, for example, but there's no access control. So currently anybody can claim rewards, and that's obviously no good. That's a big problem if you've not put access control in place effectively. So key functionality is really important to put access control in place. And it's not just on certain things like claiming rewards or things like that, but it could be emergency pause or pausing, or introducing a new whitelist mechanism if you've got an upgradable platform. A lot of these key functionalities in your protocol need access control for sure. This does introduce some centralization. Sorry, Iryna. This does introduce some centralization risks to a degree, and that needs to be mitigated. So it would work in conjunction with access control that you need to have a look at. And as far as reentrancy is concerned, I mean, it's a buzzword these days, reentrancy, but it happens more often than not still. And it can happen between multiple functions. So that's called cross-function reentrancy. And it's a case where the smart contract has received an instruction, but it's still in the process of doing so. And somebody then decides to recall that function to disrupt the contract state. And that can result in, again, fund leakage, token loss, lots of ways that this can disrupt your protocol. So that's really important to still address. And then integer overflow is a little bit of a nuance. It's basically where calculations between dividing, adding, multiplication can result in rounding just because of the way that smart contracts are ultimately set up at a low level. So there's the coding language behind smart contracts has certain rules. And if you don't adhere to those rules from a mathematical perspective, it can result in integer overflow and overflow and under, sorry. And unfortunately, this can go in the favor of your system. It could also go in the favor of the user. So it could be that you end up with more funds or tokens than you expect, or vice versa. And that's obviously not going to be good for global accounting. And then you've got logical errors. So in smart contract security, I come across this quite often. It's typically the business logic bugs that appear more often than not. And we can talk about access control and reentrancy and some of the top vulnerabilities to look for. But I would say the less trivial bugs to look for are in business logic. And so, for example, if you've got state inconsistency, and so state variables not being updated when they should be, this could be accounting, this could be the balance of your overall system, could be a balance of a user. These things need to be updated in between key function calls. And then, of course, front running is still in the top 10 smart contract vulnerabilities. This is where basically someone can call the function before somebody else by submitting a higher gas percentage, if you like, to that function in order for that person to have their execution done quickly, more quickly than the other person. So front running is quite difficult to mitigate, but there are certain patterns that you can do and adhere to make sure that it's mitigated as much as possible. And then, of course, we want to make sure that transfer restriction bypass is in place, and same with KYC and AML, investor limit bypass, and making sure that regulatory trigger bypasses are all in place before, and that these things are reported on, just in case that there is an issue. You want to make sure that it is flagged. Brilliant. So yeah, these are great. These are some common design patterns that you can implement to prevent some of the previous issues we discussed. So checks, effects, interaction pattern. I use this all the time. This is effectively at a high level. Let me explain. So if you've got a big core function that's, I don't know, the claim function, for example, to get rewards from your rental or your dividends income, we want to make sure that you are checking that the right person can call it, for example. We want to make sure that after that person has been verified, the interactions made, so that for example, the state of your contracts are updated to reflect that. And then, sorry, that's the effects. And then we want to make the interaction after that. So it could be to distribute at that point the tokens or the funds that are owed to the investor. So that pattern's really core in the smart contract world. You're supposed to follow it all the time. Every time you've got key functions, whether it's deposit or claim, checks, effects, interaction patterns always there. So it does prevent reentrancy attacks and state changes. And also, of course, for some people have functions where they don't have this and they've mismatched that order, and that can also introduce problems. So that design pattern's in there for a reason. And then access control. So OpenZeppelin are great at that. They've got libraries to provide access control mechanisms. I use it quite often, and it's basically called the access control library. and it's just configuring that. And I would strongly advise you stick to that. I think it's been robust and severely tested. And same with multi-signatures, they do tend to offer that out of the box as well. I think there are other providers such as Safe Wallet have a really good UI for operating multi-signature wallets. And same with time lock and governance. OpenZeppelin have some fantastic libraries for that have been battle tested. But a lot of the time, you've got to customize those things and then implement them. And then we move on to upgradability. Now, there are various upgradable patterns to follow. You've got the diamond proxy pattern, the UUPS pattern, transparency pattern, and there are a few others. Personally, these add a degree of additional risk to your protocol because there's been many instances of a lack of due diligence on proxy patterns, and a lot of people don't quite understand them. And there are Ethereum standards, if you like, to adhere to when it comes to upgradability. So that's really important. They do add a degree of complexity, but they're very good in terms of if you want to go and make changes to your protocol once it's launched or in production. This is a really good pattern to use. And then, of course, we move finally on to compliance patterns. So whitelisting management, transfer restriction enforcement, regulatory trigger mechanisms, and audit trail logging, which we did touch on previously. So I just wanted to emphasize that further at this point. Okay, fantastic. So equity rights. So from a development perspective, this is customization. There are standards to use in real-world tokenization development, but we want to make sure that this works in conjunction, believe it or not, with some of the things we spoke about earlier regarding voting. So we want to make sure that there's on-chain voting mechanisms, voting delegation, vote weighting, and proposal creation and execution. And just to touch on that, it could be, like Iryna mentioned earlier, if there's a sale of a property and investors and token holders have a right to vote on whether that goes through or not, well, we want to make sure that the right patterns are in place. So whoever's responsible for selling the property, the developer or the property owner, they can create a proposal. And those token holders that have the rights to vote on that proposal can do so seamlessly. And that works very similarly with dividends rights. The owner of the platform can confirm that X person has this amount owed to them. And again, we want to be able to prove that with correct accounting and the correct function flow. So people that are owed that money can go through and claim their functions seamlessly without any issues effectively. So ownership rights are something that we write into the smart contract infrastructure, and we write that in the securest way with the patterns that we mentioned already. And so the ownership is verifiable on the blockchain. We have registry contracts that verify token ownership, and distribution contracts that ultimately distribute the dividends out as well. So there, you have to look at this as smart contracts that are talking to each other in an autonomous fashion in order to bring all of this into possibility, basically. And so we test that, make sure that the dividend calculation accuracy is in place. Again, that's something that we do from a mathematical perspective, as touched on before. We do that avoiding any integer overflow and underflow issues. Yeah, that's it. So we can move on to the next slide, please, Iryna. And then implementing debt rights in smart contracts is done very similarly. So from a programmatic perspective, we write smart contracts that record all of this. So if there's any debt rights that token holders have, that at least repayment or people that owe the money, at least that's accounted for, and correctly from an autonomous perspective, it's distributed back to the protocol or the platform owner, whoever is owed the money, basically. And so we make sure that there are accrual mechanisms in place, payment schedules. This is all smart contract infrastructure that you can write. So for again, coming back to the time lock part and the maturity part, you can write that in so that everybody knows that that person's owed the money at this given point, and exceptions can be thrown if, for example, they tried to do it before or after the date of which they basically need to owe the money or the debt rights, as you're aware. And so we basically write into the contracts, the covenant agreements, and we stipulate what the parameters are if, for example, someone tries to arbitrarily or deliberately breach those written rules, if you like. We have that in place. And if, for example, there are instances where that can be bypassed, we add additional layers of protection for remediation, basically. And again, a lot of these are recorded as events as well. So we typically make sure that they are emitted to the overall backend system so that whoever's in control of the protocol can be alerted, basically. So implement bond and token. Sorry, Iryna. Yeah, perfect. Thanks. So what we implement is bond and token contracts, interest calculation modules, payment processing contracts, similar to distribution contracts, and covenant monitoring contracts. And we test the calculation of the afford, basically, just to make sure that the expected behavior is what we are expected as an outcome, basically. Fantastic. So net asset value calculations, redemption rights, distribution rights are all of what is covered in the smart contract architecture build, as mentioned a minute ago. And we make sure that it's done and tested securely. And I'll come on to that in the next slide regarding, I think it's the next slide regarding testing. And these are the things that we basically look to implement and test at a low level to make sure that it's robust in production. Brilliant. So real estate tokenization. So this is popular. Everybody's talking about it. And on the blockchain, it's easy because you can record everything. So fractional token ownership is recorded, the title, the ownership, transfership, and property registry. A lot of this exists in what's called metadata. And so we can query metadata per investor or user. No problem with that. And that obviously ties into how much that person is owed when it comes to income distribution and the types of payment processing in place as well. Sometimes some protocols prefer to distribute rewards in stable coins like USDC or USDT. There could be a conversion or an exchange of some sort if they do have the regulatory license to do so. And in that case, then rewards could be distributed in fiat, dependent on if that's in place, of course. And then, of course, when it comes to property management, we'd have a dashboard available for the admin to log in and out of and see what's basically going on with the protocol. They have ways to query how much they've accrued in maintenance fees. They can update the property valuation. There's insurance management in there. And of course, you have to have an admin dashboard for regulatory compliance reasons. And so we implement property token contracts, income distribution contracts, management fee contracts, and valuation Oracle integration. Some of that can be handled from an off-chain perspective with the likes of Chainlink, who you may or may not have heard of, but Chainlink aggregate real world data and bring it onto the blockchain. When it comes to evaluating blockchain-based assets. And so we test all of those things when it comes to Oracle integration security. Again, that's less trivial than some of the other vulnerabilities that we discussed, but Oracle manipulation does happen with flash loans. It can also happen in an arbitrary sense if the oracles you rely on are, I don't know, a little bit buggy, or they're not returning real life data, or perhaps there's some staleness involved. Again, you have to make sure that you are prepared for those edge cases and how to deal with them from an on-chain perspective, at least. So we deal with all of those things. The transfer restrictions in code and why that's important. Again, this comes down to access control and flow of funds, of course, and flow. You want to make sure that this is done correctly. And I touched on this earlier when it comes to dynamic whitelist. So you might want to update that more often than not based on whatever reason. It could be based on preference, but say you want to add or remove people or assets from a whitelist, then you should certainly be able to do so. And that again ties into whether you want to implement lockup mechanisms. So it could be, say, for example, if you want something basic, there's no secondary market, you want to facilitate a lockup period of a year. So you're using a real estate tokenization platform and you want investors to lock in for a year, you'd need to write that in. And then, of course, if someone tries to be naughty and claim their rewards prior, then your system will just throw an error and say they can't, basically. And that's simply because you would write that in at smart contract level. And then, of course, if you want to implement transfer limits, you can do so as well. So transferring rights or tokens to other people on within your platform. If you want to facilitate that, you can and you should be able to do that. From a security perspective, you want to make sure that it's time-based and there are limits involved per address as well, because people might try and game the system by having multiple addresses. Again, this is another smart attack vector. You want to make sure you facilitate that behavior or not facilitate it, and make sure that that nature does happen. Your system can cover it, basically. And so we implement those things from a whitelisting perspective, a lockup mechanism, and transfer limits as well. Great. So the implementation of compliance triggers. So we want to look at some specific scenarios such as suspension. So if you've got, I don't know, someone in the ecosystem is just not behaving, for example, or they're not being compliant, or they were, or they're not, whatever they're doing, it's nefarious. You should have the capability to what I call is blacklist. And now we've talked about suspension, but this is ultimately in smart contract sense, a mechanism called blacklisting that you can stop an individual from no longer participating in your platform for whatever reason. That's actually really important. And we want to make sure that that behavior is recorded. Similarly to redemption, transfer freeze triggers. Again, you want to be able to freeze or put, it's like a mini pause mechanism on a given individual's behavior or access. You want to be able to do that. And same with governance as well. And so, say, for example, you're in the middle of a proposal and something doesn't quite look right. You want to be able to write and make sure that you're pausing or stopping certain governance from going through for whatever reason. Similarly with KYC and AML. And when it comes to investor limit triggers, again, if you're relying on a certain amount of people getting involved in your platform and those people are set to do certain things within a given time period, we want to make sure that those limits are enforced. And so we implement regulatory trigger contracts, integration modules for KYC, AML, investor limit enforcement, and compliance as far as Oracle integration is concerned, and we test all those things. Fantastic. So there are smart contracts, and this is why it works very, very well together, actually. So there are smart contracts that have on-chain compliance, and there are token standards that we use that are battle tested. So they are very commonly used by a lot of real world tokenization platforms to record registry, whitelisting, lockups, things like that. So based on what we spoke about in the last slide, this is actually where it gets enforced. There's standards that we have and we can write and slightly customize to meet this standard. And then, of course, it works in conjunction with off-chain compliance with the traditional KYC provider process, if you like, that works in conjunction with that. And so that's like a hybrid approach, and it basically facilitates the on and off chain decisions and compliance standards that are mandated, basically. And again, we use that approach for Oracle integration for compliance and event logging for audit trails, which is what the regulator likes. And then off-chain verification in conjunction with on-chain verification. So here are the type of things that we log. And from a smart contract perspective, a lot of these events are already catered for, but you need to aggregate that data and bring it into your system from a regulatory perspective. So all token transfers, when it comes to transferring what we call ERC20 standard tokens, they do have events that are emitted that you can see on the blockchain, but it's your job to record those events. So you can capture that event, record it in your system. Excuse me. From a mandatory perspective, you will need to do those things. The same goes with compliance. Any other regulatory triggers, admin actions, which is really important. And I touched earlier about access control libraries that Open Zeppelin provide. Well, they typically also have events that are emitted every time an admin action is triggered, but you should certainly capture that data. And that's the common theme here. Same with upgrade events as well. I think upgradability ultimately at root level changes your system to a degree. So that needs to be recorded. So all event logging transfers to from the amount, the timestamp, your compliance checks, your results, your reasons for compliance being authorized or not, any other regulatory triggers or actions, and admin facilitated function flows. All of these things need to be logged in your system. And similarly with off-chain integration, again, this is more accounting orientated alongside some compliance monitoring. All of these things are expected from a technical perspective, at least, as well. So earlier I touched on testing. And so these are the methodologies that we use to ensure robust testing in place. So static analysis, code of vulnerability scanning, security pattern detection, and best practice compliance. And I'll touch in a moment on gas optimization. So there are some tools that we've contributed to on the market everywhere. Some of them are just purely static, and they are important to run. So for the likes of Slither, you've got Mithril and a few others, and they're really cool at detecting at face value, I would say, the high level vulnerability patterns. They're very good at detecting those things, and you should run them prior to doing these next steps. And similarly with gas optimization, they also show you to a degree where you may be able to save a bit of money when you deploy your contracts onto the blockchain. Dynamic testing. So this is where we implement fuzzing. Now, fuzzing is basically no different to fuzzing in the traditional cybersecurity space. It's no different. The concept's the same here. So what we do is we start to throw random values at all the key functions in your protocol just to see if there are any unexpected behaviors off the bat of that, basically. Similarly with property-based testing, they work very closely together. We test some of the key invariants, if you like, in your protocol, and we start looking at attack simulations in line with the top 10 vulnerabilities that exist, and then we move on to something more nuanced, with edge cases and integration testing. So integration, obviously, of course, is from end to end. We want to make sure that everything works perfectly fine, and edge cases could be anything as little as anything from a read-only reentrancy attack to something like a governance flash loan attack, for example. Then we look at formal verification. So that's mathematical proof of critical properties and sometimes can be mathematical proof of cryptographic signatures. And then we look at invariants. So invariants are basically your core state, right? So for example, if you've got an automated market maker system, we want to make sure that your overall balance doesn't somehow coincide with people being able to deposit more or less than what they should be able to. And in the case of real estate tokenization, for example, it could be that somebody should not be allowed a certain amount of tokens beyond that has been distributed. Those are invariants at a high level that you want to test always remain the same throughout the core functionality of your entire ecosystem, and which ties in with security property validation of those invariants. and the compliance side of those things as well. And then we move on to what we do like a manual review. And this is where business logic comes in. We start to question what state variables have not been updated during function flows. Or is your mapping all correct? Have you checked if there's a possibility for malicious payload or call data to be passed to key functions? We look at business logic, economic attack vectors such as flash loan attacks or Oracle manipulation. And at this stage, we still look at a compliance logic review from a fairly low level perspective. Now, do we use AI tools to do some of these things? There are some great tools out there, but I would strongly recommend everybody do a manual review of your core code, basically. Great. So we look at what we test, again, going back to the transfer restrictions, the compliance triggers, your legal rights, and audit trails. Some of the core things to take away from here, are voting mechanisms, your dividends, transfer ownership security, any corporate actions from an admin perspective, whitelist enforcement, again, falls under that category. Want to make sure that end to end, that all works seamlessly. And again, the previous methodologies that we just discussed with testing do sometimes uncover whether this is in place or not. And what are the MiCA requirements for smart contracts? Well, this is interesting. So mandatory smart contract audits before authorization. This is basically before you go into production, you must get a smart contract security review done on your entire architecture. So there are security testing requirements that are needed, code level vulnerability detection, economic attack vector analysis, and compliance verification logic. They want comprehensive audit reports, not, well, I'll just use this static analyzer to scan my entire protocol and it's come back with X, Y, and Z. They don't want that. They want everything. And so our role is to do that for you, is to help you with conducting security audits based on the process that I just disclosed, generate audit reports. More often than not, we do find vulnerabilities because that's our job. And then there's a remediation of that. So if we make a recommendation to solve the problem, we want to make sure that you've gone off the back of that and implemented it correctly and not reintroduced another bug or vulnerability, basically. So overall, this is like a roadmap of how long it should take for each phase. So within the first 1 to 3 weeks, Iryna and her team most likely would be involved in the design phase, so getting all the legal and corporate documents together. And then, of course, we would jump in, with the security and the tech infrastructure design, so the architecture from A to Z. And then within phase 2, that's when the development work starts for designing the smart contracts, putting all of the security elements in place, setting up the testing framework as well. And at that point, we would look at a pre-production type of situation where we're doing a security audit within the 8 to 11 weeks. And that's where we do some more in-depth and thorough testing. And we kind of leave some time at the end for remediation. So like I said a minute ago, it's most likely that we do find something that's not quite right and we make a suggestion and then you go away and implement it. And then we look at the remediation of that just to make sure that everything's okay before going to production. And then, of course, in phase 5, there's ongoing monitoring, incident response, and compliance issues that we need to do on a monthly basis, basically, just to make sure that everything is secure and you are adhering to regulatory requirements. Fantastic. I'll hand back to you then, Iryna.
Thanks, Joe. Amazing presentation, very detailed. So, what we often see is that projects either have a perfect legal side, but lack of accuracy in the technical implementation, or vice versa. And that's where most problems start. So, what we've built together with Sentinel Core is a fully integrated turnkey solution that bridges the gap between legal and technical implementation. So, legal notes focuses on defining the legal and regulatory architecture of the project, like the legal wrapper, the entities that needs to be incorporated, designing the transfer restrictions, specifying compliance triggers, supporting licenses, regulatory strategy, and Sentinel Core designs these secure smart contracts, and they require technical architecture tests and supports you through the audits to make sure that you have perfectly functioning smart contracts. And together we complete this whole RWA tokenization solution that actually turns your securities into tokens on the blockchain in a perfect manner and in a way where legal documentation is perfectly aligned with the expectations of US issuers, expectations of investors, and the operational logic of how this needs to function. So we welcome you to book a free discovery sessions with Legal Notes or with Sentinel Core. Please feel free to scan those QR codes that will take you to the pages where you can book your sessions and discuss your specific projects in more detail and see how we can turn your idea into tokenized reality. So we are ready to start the Q&A session. We thank you for being with us till the very end of this presentation, and we can start taking the questions. Victor, can you please read the questions for us so we can answer?
Hi, thank you so much for the session. We have a couple questions. I don't know, Iryna, could you assess the Q&A session from your end, or do you need me to read the questions out loud?
Let me see. Okay, so let's see. So Q&A box. The first question is about AML KYC compliance. What part of AML KYC compliance check can be automated in token? I think that was pretty much covered during the presentation. The question was submitted quite early. Do we still need to cover more on this? Alexander, can you please send a clarification if there are any gaps in your understanding of this project? While Alexander responds on this, I'll read his next question. If I'm the holder of deliverable gold contract token, how will the delivery happen? Who is responsible for whole process in your opinion? Thanks for the question. That's very interesting. So first of all, your legal documentation, the token terms, the subscription agreement would most probably define the exact delivery methods, who's covering the costs of delivery, insurance, etc. So usually the actual gold is stored by a licensed custodian. The issuer issues the note or the legal document that is linked to the token or mirrors the token, let's say. And usually the delivery happens from the custodian to the token holder as per the predefined terms of the legal documentation that is accepted by the token holder at the time when you obtain the token. That's a very high level of this process. And again, one more question from Alexander. If I have token for Google equity and Google is about to pay dividends, how will Google and its custodian know about my token holdings? Again, very valuable question, thanks. And so I think we need to begin with who actually issued your equity token. Is this Google directly, or are you a holder of some kind of a derivative security token, which is not directly issued by Google, but maybe by a fund that holds certain shares in multiple companies, most probably, and you own that derivative that allows you to receive certain yield from your token. And so if it's a Google directly, then it's more or less clear scenario, because Google and the transfer agent involved would definitely have an up-to-date register of all shareholders. But if you hold a derivative product, then again, Google just pays the dividends to the actual shareholder, for example, a fund in this case, and then fund distributes the yield to token holders. And one more question from Alessandro. What are the average costs for the turnkey project, legal plus development, real estate lending protocol? I'm not sure we are going to be able to respond to this, because every project is deeply analyzed before we can actually estimate the costs. Joe, what do you think? How do you approach this in your team? Do you give some average pricing models or pricing methodology, how the founders could understand the approximate costs?
Yeah, so we basically operate on a complexity level. So real estate tokenization, as it were, has a few levels. Let's just say, for example, it has a few levels. So there are various packages that we do charge to our clients, and it's based on complexity. So, for example, if someone wants a very basic real world tokenization platform for real estate, no secondary market, no fancy shining features, just want to facilitate people for a year, for example, and then after that have the ability to sell and receive dividends, then we would look at something between 20 and 25 British pounds. If there is additional complexity, for example, with secondary markets or governance, or in the state of the question when it comes into lending, that's certainly an area of DeFi that's a lot more complex, and so we would charge in excess of that, of course. That opens up a lot of other attack vectors that we kind of have discussed already, and some more nuanced stuff as well. So the more of the complexity, the more that your protocol is doing, the more that we would charge in order to facilitate building and securing it, basically. So we can kind of give rough estimates, but again, it's dependent on complexity, so it's quite difficult at this stage.
Thanks, Joe. And from my side, I can just add that at Legal Notes, we have outcome-based fixed fee kind of approach, and we've designed something very helpful as a package for founders of early stage tokenization projects, where at that package, we have 4 sessions with an expert. During those sessions, we, together with the founders, analyze the project, help the founders understand what are their options in terms of corporate structure design, legal wrapper design, and how all the entities in the corporate structure are going to be interacting between themselves and with third parties like investors, custodians, oracles, regulators, and after those 4 sessions, we produce 20 to 35 pages deliverable. We call it roadmap, that gives you an exact plan of tasks for each stage of your project life cycle. And here we have a clear pricing for those type of projects. It's $3,300 for this initial analytical package of 4 sessions with the roadmap. And after that, we price the documents that need to be drafted for asset rights structuring, for offering side, on all the internal policies and other documentation on a document by document basis. So just to answer the question about the pricing, we can start with this solution, which will fill all the gaps, will answer all the questions in terms of the legal side, compliance, corporate side of things, and from there, projects have a clear handbook they can use to actually incorporate, build the architecture, legal and technical architecture, and fulfill the entire planned project. I think we'll have to wrap up here. Unfortunately, we couldn't take more questions because the topics were really extensive today, but hopefully we can answer those questions on individual sessions. We'll feel free to book those through the QR codes we've provided initially. After the webinar, the presentation is going to be shared with all the registrants, and this webinar is going to be available on legal Nodes and Sentinel Core resource centers. So feel free to watch it again, and thanks again for joining.
Thank you, guys.